The last strategy I'd like to cover today is the MVP option cycle spread strategy. This spread strategy is implemented by purchasing a stock or a leaps option and selling a 1-month option that creates a spread that profits from the very rapid time decay of the short-term option. Each month, another short-term option is sold, and that allows us to generate monthly income. Now, the sale of the 1-month option is covered by the underlying stock or by buying a long-term leaps option. Now, for new option investors, this strategy may be a little difficult to grasp initially, but I think it's well worth the effort, as this strategy has one of the best risk-reward profiles available. And let's take a look at a recent option cycle spread strategy trade that I took. Monsanto qualifies as an MVP trendline strategy stock, and my brokerage confirmations right here show that I purchased 3 of the Monsanto January 09 leaps options. Now these expire in about 13 months, and I purchased those for 43.51 points. It's a little hard to see there. And I sold 3 of the Monsanto January 08 115 strike calls. Now the January 08, I purchased these on December 21st, which was December option expiration. So the January 08 115 strike calls that I sold here expire in a month. And I sold those for 3.96 points. So the cost of this spread was $3,955, and we calculate the cost by subtracting the $396 I received for the sale of the 1-month option from the cost, from the $43.50 cost of the leaps option, and the net result was the spread cost $3,955. Now Monsanto stock was trading at 111.50 at the time I initiated this spread, so that the sale of this 115 strike call was an out-of-the-money option. And of course, out-of-the-money options consist of only time value, and options lose all their time value at option expiration. So in 1 month, I get to pocket this $396 regardless of the price direction of Monsanto stock, whether it goes up, stays flat, or goes down. This $396 of time value I get to keep. Now at January option expiration, which was last Friday, Monsanto stock was trading at 105. So the January 115 strike I sold, the 1-month option, expired worthless, and I sold the February 08 95 calls for $8.10, or 8.10 points, which is $810. So again, to initiate the spread, I bought the 3 leaps options. I sold the January 08, which is a 1-month option, and then at January option expiration, I sold 3 of the February 95 calls. And this process is repeated every month for the life of the leaps option. Now February 15th is February option expiration, and I'll sell 3 of the Monsanto at the money calls, whatever that price is on February option expiration day. And we just keep repeating this process every month until the leaps option expires. So bottom line, this allows me to sell 12 of these monthly options, and if you total that up, this trade has a $9,600 potential cash income, and my initial investment was $3,955. So that's a very good return for a strategy, a low-risk strategy like this. And again, you can sell this monthly option every month, regardless of whether the stock goes up or down, and it generates this monthly cash income each month, which can really add up here. Like I say, over a 12-month period, I could receive up to $9,600 in income. Now, one other advantage of this strategy is if Monsanto stock decreases, then the short option can be rolled over, and this can increase your income. And for example, I sold the February 95 calls for Monsanto. Now, if Monsanto stock drops to, let's say, 90 or 85, then I'll buy back this short 95 call, make a profit on that closeout, and then I'll sell another February call with a lower strike price, and that will increase my income. So this is a very flexible strategy, and as long as the stock keeps going down, you can keep rolling over the short option, and it'll increase your income as you roll over. And lately, I've done a lot of rollovers with these spread positions because the stocks have been going down. And for example, for Apple stock, I know that's gone down considerably lately, but over a 30-day period, I collected almost 45 points of time pressure, or of time value, or time profit, by rolling over the short option into a lower strike price. So that's a really good strategy for down markets, because you can keep rolling over this short option as the stock goes down in price.